Hey, what's up? This is Damon from StockBarometer.com. Today I'm going to give you a few stock picks for next week, the week of February 2nd, 2015. We are going to look at only bullish stocks, so I'm going to give you stock picks that you should probably buy into if you have the money or if you already are supportive of these companies and are more or less on the fence, deciding whether to get in or not. Also, if you don't have a lot of money, because some of these stocks are actually quite expensive, such as the first one, Amazon, at 300 bucks, you might want to use options, buy a call option. You can save money that way. You can get in on the position, and it's basically like you have stock. The only exception is that you have an expiration date with that options contract, and if you're not right, or if my predictions I'm about to give you aren't right, then you'll lose money. Now, as a disclaimer, I'll just say that this is not real advice. I'm just giving you my opinion, my quote unquote expert opinion on whether these stocks will go up or down based on candlestick analysis and based on gap analysis. So I'm just using my own method of analysis to point out the direction of stocks. And I can say that actually I'm pretty trustworthy. You check my newsletters, and you'll see that we have quite good performance both in gap trading and in options trading. So I'm just putting it out there. Anyway, let's get ahead to looking at the stocks. Let's move on to looking at the individual stocks. The first of which is Amazon. Oh, first of which is Amazon. I'll just close Skype. 1 second. First of which is Amazon. Now, Amazon is a very interesting stock because it has been trending sideways more or less for the past month. Of course, there's a lot of money to be made even on a trend that is sideways if your stock is trading at high numbers like 300 bucks, right? So you can move from here to here and you made 10 bucks if you shorted the stock. But we're not going to deal with that kind of stock because it's not very predictable until you see something like we saw on Friday, which was a very large gap. The size of this gap indicates that it's probably a gap known as a breakaway gap, which tends to widen. In other words, if the gap is upwards, the stock direction tends to also be upwards after that gap. Now, we also need to look at the volume. If the volume is high, then we're even more confident that the gap is a breakaway gap. Now, based on my experience, breakaway gaps tend to really continue upward at a fast pace. But there's another possibility, which is they more or less even out at that price. Generally, breakaway gaps, if we are predicting them correctly as being breakaway gaps, will not fall, will not fill for a long period of time. So these are usually safe plays in gap trading. My suggestion would be to buy Amazon on Monday if you see that indeed Monday's stock price opens at least at the same opening price of Friday's stock. So if we see a stock price that's about, what was the opening price here? 364 bucks. If we see Amazon opening above 364 bucks on Monday, we should buy Amazon stock or buy a call option, which is probably more reasonable on Amazon. Okay, that is number one. Number two is what is it called? Regulus. I've been outside of the US for so long, encountering unfamiliar words gives me pronunciation problems. And apparently, either my internet's super slow. All right, there we are. RGLS. RGLS, a biotechnology stock that more or less has been trending. I hate going back to this chart, pisses me off. More or less has been trending slightly upward for a while, but we have not seen any indications that it's going to move upward quickly. So here is the candlestick chart for, okay, that's the last day. We don't care about that. Here's the candlestick chart for the last month. We see an area gap here. So after this, we would know that the stock would drop a bit. Then we see another gap here, tiny gap. so it's insignificant, but you can also imagine that this gap is going to fill because of how small the gap is. So we would again be bearish here, wait for the gap to fill, and now we see something that that resembles, not completely, but it's very close to a, oh, it technically is. It technically is a bullish engulfing candlestick where the green candle is bigger than the previous red candle, which would imply an upward trend, which we do see. And it continues upward until we see a bearish harami. A bearish harami is when you have a green candlestick and a red candlestick that's much smaller in the middle, in pretty much exactly the middle, which implies a downward trend following that. Then again, we see a bullish harami where we have a green candlestick within the red candlestick, and that is more or less confirmed by another green candlestick that has a pricing, an opening price that matches the previous day's closing price. So we see a lot of complicated tiny trends in this stock chart, and if you're a day trader or if you trade this every day, you could have made quite a bit of money, swing trading every few days here. But I didn't recommend this stock earlier simply because the trends tend to be short-lived. However, this kind of candlestick chart where you see a bullish harami followed by another bullish candlestick generally implies that the following bullish trend is going to move much more quickly than previously. So we might even see something again like this where it moves up $4 in the next couple days. So I would recommend getting in on this if you can. You could always just buy a call option if you don't want to spend 20 bucks per share. So that is, I don't know how to say it, RGLS. What is the next one? I gotta go up to my list. Give me a second. Okay, next one. What website are we on? Well, we are on Yahoo. Fortunately, the website we are using is probably going to be around for a while because Yahoo is looking pretty good. However, Yahoo's charts start to piss me off after a while because they're so slow sometimes. Alright, I said Yahoo's looking pretty good, right? But what we see is Yahoo actually dropped quite a bit. Well, this gap right here, where the volume is higher, but you can see it moved to become higher at a progressive pace. It didn't spike. Likewise, after the gap, the volume slowly went down. Now, again, this type of gap has two possibilities, especially when you see the volume dropping. It is possible that the gap will stabilize and just trend sideways. That's one possibility. The other possibility, which is more probable and which is why I recommended this stock. Oh, by the way, this candlestick pattern right here, these three, this is called an evening star. And if you see this candlestick pattern, be prepared for a bearish drop, which we see right here. So at this point, okay, even better. All right, I wish I analyzed this last week, during last week, because what we have here is we have 5 candlesticks, actually 4. 4 is really what matters here. We have 4 green candlesticks upward. You would think that this means the stock is going to continue trending upward, but if we have 4 days in a row that go upward or downward, it usually implies that now the stock is overbought, or alternatively, for 4 days downward, it would imply that the stock is oversold, and it usually reverses direction. So if we were swing trading Yahoo, we would see, 4 days, I'm going to decide to get in on the next day. So you'd get on the next day, you'd buy around here, and then you'd ride the next trend because now it's going to be bullish after you see, usually it's going to be bullish after you see 4 red candlesticks in a row that are progressively lower. Now it's going to be bullish, so you ride that up. Now, at this point, you see, the last 4 days have all been bullish, and it's been getting progressively higher. Now it's time to get out. So you would have bought low, sold high, and then actually, if you held on for the next day, for the next couple of days, you could have actually gotten out here. What I would actually do is I would buy here. I would watch these 4 candlestick patterns. I'd buy here. I would watch these 4 candlesticks patterns. I would sell here, so I would have made about $2 per share on profit. Then I would see, these 3 candlesticks make a evening star pattern So I would actually short the stock at this time. Or I would buy a put option, which is essentially the same as shorting the stock. So at this time, I would say, okay, time to short the stock, buy a put option, buy the put option, boom, way down here. I would hold on for a bit to see which way it's going to go. So I'd hold on until Friday, and on Friday I would have sold it back. Now, for a put option like this, if I actually bought a put option at about $49 and it dropped to $43, the put option might have cost me $100, but I could have sold it for about $600. So I would have made 600 ROI on that trade. Now, of course, if you're shorting stock, you would be making less than that, but still you'd be making, $7, 6 or 7 bucks, um, in a 4-day time span, which would be great. Now, why am I bringing up Yahoo right now? Well, this gap is quite likely an area gap, which fills. An area gap fills generally, which means that if you see an area gap down, like we're seeing, like we saw on Friday or Thursday, sorry, it's going to fill. So it's going to move from 43 at least back up to around 46. So that's, well, it's not 43 right now, it's 44. So that's like $2 profit region. And if you're playing options, that's about 200 extra dollars per option contract. Now, I've been playing Yahoo for a long time. I've been playing Yahoo for probably about a year, swing trading. Or not a year, that's overestimating, maybe 6 months. And its area gaps do really close quite quickly. And I almost only trade area gaps on Yahoo. This would be a great example of an area gap to trade. So if you see this by, during the weekend and you want to get in on Monday, I really highly recommend you buy stock. You might want to buy a call option, but that's a little more risky because if it trends sideways, you're going to lose money. However, if you buy stock and it trends sideways, you don't lose any money. And it will probably slowly, if it doesn't immediately, it will slowly go up back to $46 or $47. So that is my second recommendation. No, that's my third recommendation, sorry. Next would be Dow Chemicals. Energy drink, delicious. Tastes like chemicals. Okay, Dow Chemical Company. Very popular stock, very high volume, easy to trade, good spreads. What is interesting about Dow here? Well, first of all, there's something that looks kind of like a gap here, but because the shadows, if you look at the shadows are the little tips, the wicks of the candlesticks, because the shadows pretty much touch, I wouldn't really even consider that a gap. But if you consider it a gap, you see the volume is a bit high. It's still kind of inconclusive. You can't tell if it's going to be a breakaway gap where it continues downward or if it's going to be an area gap. So this is the kind of gap I usually stay away from trading. What it ended up being is, kind of a half-half. It did go down for a bit, and then it did fill later. So really, I wouldn't even play with this kind of gap. We're not looking at the gap for this stop. We're looking at what we saw on Thursday and Friday, which was a 2 white soldier pattern with the white soldiers quite a bit lower. Now, this is not really a interesting candlestick pattern, but it is a consistent candlestick pattern. When you have what looks to be a bearish engulfing pattern where the red candlestick eats the green candlestick, but then on the next day you find that it's incorrect to a great degree. In other words, the resultant candlestick is much higher than you would expect it to be, and then the day after that you see a confirmation that the trend has actually reversed. You can expect this trend to go upward rather slowly. It's not a fast trend, but you can usually expect a bullish trend from this type of pattern. So you basically have a bearish engulfing followed by another candlestick pattern that says bullish. In other words, we were wrong on the bearish engulfing to such a great degree that the next candlestick pattern is more or less confirmed retroactively. It's a strange theory, and I'm not even 100% sure it's backed by statistics. So if you're a statistical trader like I am, you might want to stay away from this because I'm just telling you what I find through my hours and hours of analysis every week on stocks. But I have seen this quite often, and it usually tends to trend upward. I would say get in on this, get on a stock or buy a call option if you have some extra money to spare. If you've already done all the other plays you want to do next week, this is a nice backup play. Okay, that's Dow. What else we got? All right, I'm checking my list here. All right, I've been telling people, I haven't been telling people in my newsletter this, but I've been wanting to recommend. I have 3 newsletters in which I recommend stock, and I've been wanting to tell people to get into oil for a while because I think oil is more or less as low as it's going to be for a while. Now, I've been really wary of making that recommendation. I did make a penny stock oil recommendation, but for everything else, was it oil? It was some sort of energy stock. It might not have even been oil. But for everything else, I've been wary about making a recommendation on oil because I don't want people to think that oil really has touched bottom when it might not have. But these days, I'm even more confident that now is more or less the right time to get in on oil. So I'm going to make the recommendation to buy this oil ETF in the United States. It's called USO. It's actually a pretty highly traded ETF for oil. Another option would be a bullish 3 times velocity shares ETF, which gets you, which you'd make more money on that if oil starts to surge. But I think this United States oil ETF is a little more conservative of a pick. If oil continues to fall, you won't lose much money like you would in the crude 3 times velocity shares ETF. So I'm going to recommend this standard United States oil ETF, not only because of the fact that oil is, lower than more or less ever, but also because of what we see here, which is we've got all right, okay, let's start with the gap. We've got a few gaps. These gaps are quite obvious. Oil has been gapping down for a while. It continues to gap down. This is something you could explain better through news than through technical analysis. Oil is dropping, everybody's scared, they're selling oil. Okay, but now that it's more or less stabilized at around 18, we see smaller gaps, and the gaps tend to fill. So here's a tiny, tiny gap from this wick to the top of this red candlestick, and we don't see any significant change in volume. So we can just assume that this is most likely going to fill, which it does. It does fill 2 days later. And then it continues trending sideways. And, again, oil is quite bearish, so it's trending downward again. And then on Friday, we saw something a little interesting. It jumped about $1, actually more than $1. And it jumped in front of a candlestick that showed a bit of resistance, not resistance, a bit of support downwards. So you see how this candlestick, not only is it small, not only is its body small, which indicates investor indecision, but also the wick is only at the bottom. There's no wick at the top. And when you see something like that, this is called a hammer candlestick. When you see something like that, you generally can assume that you have a level of support below, and the stock is most likely not going to drop much further. This holds true for ETFs as well. When you see that, you can guess that, well, we've got a hammer candlestick that's indicating a level of support. It might not go up the next day, but at the very least, it's probably not going to drop any further. So if you saw this, you might have decided to get in on Friday, and if you did, good for you, you made $1. Now, what we did see on Friday was a confirmation of this hammer candlestick pattern, and we saw a candlestick, the biggest green candlestick we've seen all month, which could indicate a reversal, a bullish reversal for oil. Now, the only question about this is, what about this wick right here? Is this wick long enough to assume that there is a level of resistance at $18? That's a question that is as of yet unanswered. So like the first stock we looked at, which was Amazon, I would say watch what happens on Monday. If on Monday we see that this ETF opens at above $18, it might be a good time to get in. It might be showing a real reversal where these two area gaps will actually fill. And we can actually make a $2 profit at the very least. So this is something you should watch on Monday. And the final recommendation I have to make is this weird one right here. SYRG. I'm not familiar with this stock, but I've been looking at the analysis for a bit. Synergy Resources Corporation. It's not trading at a very high level, so it's easy to get in. I wanted to choose a lower price stock for some people. What we see here is a gap, a very significant gap, because it drops to a level that we had not seen in the previous month. But also, because the volume is so large, we would assume that it's probably a breakaway gap. Now, if you are a gap trader like I am, your most profitable gap trading strategy is not going to be to trade on the day of the gap, but to watch what happens 2 to 5 days after the gap. So including this candlestick, we want to count at least 2 candlesticks. So it could be these two, but we also at the max we want to look at 5 candlesticks. So we could actually watch all the way until Tuesday to decide which way to go. But what actually we did see was an immediate reversal. The next day that gap filled right away with a level of support. You see that wick at the bottom? We have a level of support that says this stock is probably not going to fall below $11. We have a strong level of support there. Now, on the next day, we have wicks on the top and the bottom that's telling us this is not significant in either direction. In other words, we don't have a significant resistance or significant support. This is just how many candlesticks do look if you look at the past candlesticks. So this would imply an upward trend. Now, because we have this, two white, large, long soldiers pattern, we could assume that the stock is going to continue to be bullish and move upward. But another possibility is that it's simply evening out at the price it was at before. What's strange to me is this large volume on the day of the gap probably indicates news. Now you can go back and check the news if you want. It really doesn't matter. But news would usually cause investors to either overestimate or underestimate the stock price. Now what we saw here is interesting because usually it happens that the news always has an effect to where it brings the real stock price to below, if it's negative news, it brings it to below the previous day. But what we actually see is the news only affected that stock price for one day, and now the stock is moving back upward and has surpassed the price previous to the news. So what we could have seen is this stock might have been oversold already, and what happened was now people really realize this is the time to get in despite the news. The news might not have been significant, and now it's moving upward. The candlesticks, in terms of the candlesticks, there's nothing really confirmatory here, but it could be a good buy because what we're actually seeing is if we ignore these 2 days, if we just say let that be a wash, let's imagine that the gap and the comeback didn't really happen and we're just now back at our normal levels. What we really do see is a bullish engulfing. This long green one pretty much eats the previous red one. And that is usually a good sign. Not only that, but we also see this, which is the opposite of a evening star, this 3 candlestick pattern generally supports an upward trend, which didn't happen immediately, but it might happen in the future. So this is another stock that you should probably have on your watch list. See what happens on Monday if you feel that it's going to be trending upward, or if it at least opens above $12, it might be worth getting in on. Okay? That is all I have for today. So look forward to the next week. Look forward to the week of February 2nd. And if you want to learn more about gap trading, or if you want to sign up for my newsletters, please click on the links around this. Well, I'm going to put them on later. You'll see. Please click, join me, and leave some comments if you have questions. Take care. Good luck.